Markets tend to bottom 6 to 9 months before it's clear that you could have done this. And so we're a little bit off to the races in the short term. It's compounded by a couple of other factors. One is that at the end of last year, so many people were tax loss harvesting, which means if you had some gains somewhere else, you sold some things that were losing money so that you could net the two together. You saw a lot of stocks. Tesla was probably the poster child for this. Trade all the way down to like $108 a share, and it's effectively doubled in the last 30 days. Right, so everybody tax loss harvested, everybody degrossed, nobody was really owning anything. And then when Powell basically said we're mostly done, there's been so much systematic buying right now that nobody's really well positioned. To me, this is very similar and eerily reminiscent of the end of 2018 and beginning of 2019. And if you guys remember, at the end of 2018, October, November, December, the markets just fell. And part of it was Powell's going to raise rates, inflation's getting out of control, et cetera, et cetera. And then we got all this data that said China may be entering a real period of malaise, and Powell capitulated. Again, trying to stick the landing. And long story short, he didn't. That was a head fake, and the markets just ripped higher. Then we went into the COVID pandemic and all of that stuff happened. So I think we're about to replay a little bit of that. At least in the next 30 to 90 days, the pain trade is to go up. So that's probably where we're going. I think Sachs is right. I think the marginal risk here is for this whipsawing. So we have a period now which is disinflationary. But the problem is if the stock market keeps going up and all of a sudden we have less restrictive monetary conditions, then we're going to be back at the same place we were before, which is money sloshing around into all kinds of risky assets or more money. There's still an enormous amount of money sitting on the sidelines that has to come into the market now if this thing keeps going higher. So we're in a delicate moment. And if we reignite inflation because all of a sudden more companies have more liquidity that they can tap, more money they can raise, more money as a result that they can spend, because we don't have this first inflationary cycle under control, there could be a risk that we reignite inflation. And so then they have to capitulate, the Fed has to capitulate again and start another hiking cycle. So I think it's a complicated moment. I think all of the smart money in Wall Street that I talked to up until this point, they forecasted like this period would be choppy and the second half of the year would be really robust and like you needed to be super long and things were going to be incredible. And when I talked to them this week, they're like, oh God, we weren't positioned for this. We had no risk going into this. We're going to be forced buyers. There's a bunch of companies that are whispering that they want to go public now. The big banks have been calling around trying to book build quietly for some IPOs. And so if they try to kind of crack this capital markets open, I think, again, the marginal risk will be that we do whipsaw, Zach. When they call to book build, they basically say, hey, listen, XYZ company, quiet filed, look at the S1, what do you think? Where's the price? Blah, blah, blah. And they're trying to get an indication of whether you'd want to be in the IPO book. So I think that there's a lot of those testing the waters that are now starting again. The thing that we have to think about is like most of the market are not people, right? Most of the market are computers and algorithms and ETFs. It's an extremely formulaic buying model. You have components of an index, those represent certain percentages. You have to own those percentages to be relevant as that index. And so it's this reinforced buying loop as well as a reinforced selling loop, right? So when things start moving, those folks have to just systematically move money in. All the humans know that. So the humans tend to front run all the computers. And they basically are the ones that sell into these guys. And then that's what inflates these prices. Similarly, on the way down, humans try to front run it by being short into that stuff. So we could see the capital markets open. Even if we don't, it's actually the worst scenario because now you have all this money going into a fewer number of names. That sort of explains Facebook has doubled in 30, 60 days. Tesla has doubled in 30, 60 days. A lot of the tech stocks, like high beta stocks that we are all helping to build, those companies have just absolutely ripped 60 to 100%. These are not healthy and normal moves. And so the question is what happens if inflation somehow all of a sudden pokes itself back up? Right now, it doesn't look like it is. If you listen to Buffett's teacher, this guy, Ben Graham, in Ben Graham's book, the way that he would look at a stock, and obviously, look, things have changed, but the way that he would look at a stock is he would look at that risk-free rate, he would double it, and then the inverse of that is the maximum price to earnings ratio that he would pay for a stock. Right? That's the trade-off is if you can get more than 2 times the risk-free rate, then it's worth owning a company. What that means is that if you take 3.5% as a terminal rate, the right PE is around 14 for the S&P 500. Right now, the S&P 500 trades at 22 times PE, which would mean that we are 50% overvalued. Now that, again, that's a Benjamin Graham model, and I think the world has pretty cleanly moved away from it, but there's probably some rooting in that intellectual framework, that's still valuable. And to your point, David, it just reinforces that, man, we need to start to learn a new regime here, because when rates are not zero, there's just a lot of excess that you can't support, because the alternative trade-offs for investors are plentiful, and plowing money into a money-losing startup becomes less attractive. When rates intersect with the emergence of huge technology trends, so in the case of the 1970s, it was the PC revolution. In the case of the late 1990s, it was the internet revolution. Those two things, which required enormous progress in both physical infrastructure, so atoms, as well as software infrastructure, bits, when you put those two things together, those also created big companies. And so if you add that all up, the point is that whenever you see huge tectonic shifts in technology combined with periods of austerity, that's when the gargantuan dollars are made. So in the 1970s, companies like Microsoft and Apple from the get-go had to be profitable. And in the absence of one very important round of financing that Amazon was able to close, the next big wad of companies were founded again in rising rates where they just had to get profitable or find a way to be positive free cash flow or have positive working capital faster than anybody else. So these are like really interesting trends that I think just say that as rates creep back up, and if we can intersect that with some improvements in technology over the next 5 to 10 years that we've all talked about, it could be a real boon for startups and startup investing. I think that shorting falls into two buckets. One is you use it as a hedging instrument. So when we talk about spread trades like long Google, short Facebook, or long Facebook, short Google, you should be allowed to short. I think that's a very reasonable thing to do. I think the question is, if you were on the inside of a company and you say XYZ is happening, for example, Trevor Milton, and it causes the stock to go up and it turns out to be fraudulent, he's held accountable. The question is, should there be the same responsibility for people on the outside who, if they have enough distribution, can say the exact opposite of XYZ is happening? In this case, XYZ is not happening, which then causes the stock to go down. Because what the business model of these short sellers is, write a document, it looks very polished and very credible, put on some positions, then put the document out. If the stock goes down, you close it out. In my opinion, I think that short sellers are a really important part of a well-functioning market, or the ability to short. But what I would like to do is take an extra step, which is you should hold these folks accountable the same way you'd hold an insider accountable, which is almost to the effect of like, when you put out this screed, if you make money from it, it should sit in escrow and the SEC should actually adjudicate whether it's true or not. So in the case of Hindenburg and Nikola, they shorted the stock, they put out a report, it turned out they were right. All that money is completely well earned. Now, what if this Adani thing turns out to be not true or true? Nobody knows right now, except 50% of the market cap has already been wiped out. So that's where things I think are in a bit of a gray area. The last thing I'll say is that if you look at it in the developing world, there's a very gray line between some of the leading entrepreneurs and these governments, because these entrepreneurs are doing the work of some of these governments. Whether it's Ike Batista in Brazil in one moment, right around natural resources, or Adani and Ambani in India, or a lot of the people that have made a lot of money in China, or the people that are making money in developing markets, Turkey, Russia, etc. The government uses very talented entrepreneurs to go and concentrate capital to develop infrastructure progress. We did that in America in the 1800s as well. So that's where I think you have to also balance it, because his response was basically like, this is an attack on India. And in a way, you can see where he's coming from, right? Because he's building ports and roads and bridges. And he's like, without this stuff, how is India supposed to even exist in the 21st century? That's a reasonable claim. There's a person called Carson Block who's being investigated because he may have pushed the boundaries of how short sellers do this. It's a really fascinating read in The Atlantic for anybody who wants to read it. But this is sort of where the short selling thing can a little bit go awry. And it's the title of this is The Man Who Moves Markets. And it's quite a really interesting read if you're interested in how all of this stuff works.